Leadership will still be available after the formal event to engage on any other areas that you might want to explore. And then breakfast is still available, so if you haven't had breakfast, it is outside of the first door to your right. So I will now introduce members of our leadership team who are present. I will start with Mr. Supriyo Sen Gupta. He is our Group General Manager for Marketing and Communication. Gauri Gupta. She is our Group General Manager for Corporate Advisory. Mr. Gul Khan, he is our I&M Bank Kenya CEO. Mr. Amit Budev, he is our Group CFO. And last but not least, the man of the hour, Mr. Kihara Maina, our Regional CEO. And then on this other side, we have other members of our Head of Strategy, Harish, I can't pronounce his second name. He's our General Manager for Treasury. And then we've got Deepna, she's in Corporate Advisory, and Christine Sidi, she's in Investor Relations. So welcome everyone. I will now invite Kihara to come over and start us off with their presentation.
Thank you. I don't recall whether Mwihaki introduced herself, but Mwihaki Oshira is our General Manager for Marketing. Good morning and welcome to all members of the press here and our staff present as well. It's a really good opportunity for us to be able to share our results for the financial year 2022 for the I&M Group. So, I'll begin by just recapping who we are so you know who you're speaking to. And just to make sure that you appreciate the footprint that I&M has across Africa. So we are a regional banking group. We also have non-banking entities, which we'll mention in a moment. But we have a presence in 5 different geographies. Our home market being Kenya, where we have I&M Bank Kenya, which is our largest business in the group. We also have domiciled within Kenya I&M Babbage Capital, which provides advisory services to our clients, particularly helping them to raise capital and whether it is debt or equity. We also have our bank assurance business, a very strong intermediary that we use to support our customers as they are looking at insurance solutions. We have the I&M Capital business, which is regulated by the Capital Markets Authority and provides our wealth management services. This is a business we started about 2 years ago and is doing well. We also have the I&M Realty business, which looks at the property side of our group. Then we have the Mauritius business, where we have a joint venture with about 7 branches. So based in Mauritius, we call it Bank One Limited. And in Tanzania, we have I&M Bank Tanzania with 8 branches as well. In Rwanda, one of the oldest businesses that we have in the group, and certainly the oldest bank in the country there, I&M Bank Rwanda, with about 18 branches. And then the latest business that we have brought into the fold, which is I&M Uganda, which we acquired just 2 years ago, and is reporting its first full year results this year. There we also have I&M Babbage Capital as a subsidiary. So a very wide footprint. Covering over 2,500 staff as a group with 83 branches and a very wide ATM network. Right, so what is our strategic aspiration as I&M? We have been operating under our strategy, which we call Imara, and it's the Imara 2.0 cycle for now. And our aspiration as a group is to be Eastern Africa's leading financial partner for growth. Our focus areas, drawing from that aspiration, is how to grow our customers using an ecosystem banking approach. We are focused on building partnerships with strategic partners that we feel can help us deliver value for our customers. So whether they're in the financial technology space or other spaces, to make sure that we can deliver a coherent offering for our customers. We also focus on making sure that we are structured to support our aspiration. So the group operating model focuses on making sure that the functions that we have as a group deliver our strategy. We have, as a result, then also looked at the channels that we use for our customers. So of course, you'll be familiar with our branch network across the group. But as you have seen in our communications over the years, we have been ensuring that we invest in digital platforms. So our omni-channel implementation, which we call On The Go, is really giving us the kind of digital penetration that we are looking for. We have also been expanding in terms of our segments that we cover, which include recently the MSME and the retail business. And we will touch on that in a bit more detail later. And of course, a key focus for us is on the innovation side. We pride ourselves on being one of the more innovative banks in the region, and in particular, focusing on how we can leverage our digital platform to do so. So we've touched on the regional footprint that we have, and certainly from our aspiration, you will see that we say, we want to be Eastern Africa's leading financial partner for growth. And Eastern Africa makes sure that we have our eye out on opportunities as they arise in the Eastern Africa region. So coming to performance in 2022, what did it look like? Well, we have seen in recent years the turnaround that most markets have been experiencing, most of the markets that we have been operating in have been experiencing. But certainly there have been some significant headwinds. And if we start with those, we have seen that recovery from COVID has obviously run into some challenges as businesses readjust their operating models. But we have also seen that costs of living have been impacted, and I know that this is a very topical issue in Kenya, but it is a similar story in other markets in which we operate. This has been, of course, amplified by adjustments that are being made in other global markets as we see rising inflation across the globe, leading to higher interest rates, and additional geopolitical events also hurting performance across the globe. We are also struggling with the climate change issues. Certainly in Africa, we've seen one of the worst droughts in a very long time. And this is certainly leading to challenges for people. We've had to come together as a private sector. Certainly as I&M, we have been participating actively in ameliorating this impact for the most vulnerable in our communities. We touched on the issues that we are seeing globally, and that has been manifesting itself particularly in the currency markets. And we have seen the Kenya shilling, certainly, which is our home market, see significant depreciation in the shilling. But this is a story that has also been playing out in other markets in which we operate. And given all of these challenges, it has been certainly a difficult time for policymakers to balance the monetary policy imperatives that arise from this, as well as the challenges that arise from balancing the deficits for each of the countries in which we operate. So this is a tough time for policymakers, but within that context, we as a business have had to, of course, support initiatives that are brought forward by the different regulators we work with, but at the same time, look at how we can mitigate the impact for our customers. It hasn't all been doom and gloom. We also have some tailwinds that have supported us. Certainly, the recovery as we emerged from the challenges of COVID has seen growth in the Eastern Africa region, estimated at about 4.8%. And even though the recovery has been uneven, it has been positive. We have seen peaceful elections in Kenya, and that has certainly improved business confidence in the markets here, and certainly our neighbors as well. And that has meant that we have been able to more confidently invest in our business and in our other businesses across the region. That has also been the case in Tanzania, which has also seen an improved economic and business environment. And in Mauritius, which is very heavily dependent on tourism, we have also seen that as the pandemic receded, recovery has been strong and boosted really overall economic activity, and that has translated into good performance for our business. So significant challenges, but also some tailwinds that we feel have then influenced our numbers. So what have the outcomes then been for us? It has led to steady growth in our balance sheet, and we have maintained our asset quality. So you'll see that our loans and advances were up 13% year on year, closing at 239 billion shillings across the group. Deposits up 5%, up to 312 billion shillings, again across the group. Despite all the challenges that I mentioned, we have been very diligent in making sure that our prudent approach to managing the loan book bears the right kind of results, and our gross NPA has been at 10.5%, which is quite similar to what we had the previous year, and we maintain our positioning below the industry average of about 13.3%. The cost of risk, so how much money are we putting, or how much capital are we setting aside to cover the losses that we are seeing in the loan book, that has ticked up, and we are seeing that at 2.2%, showing the strong commitment that we have towards a prudent approach to managing our balance sheet. We have seen growth across all our income segments, all the different businesses that we run. And net interest income and non-interest income, you will see respectively going up from non-interest income going up from 9 to 13 billion, and net interest income up from 21 billion to 23 billion. In total, a 20% growth in net interest income on the back of the loan book that we just discussed, and of course the deposit book growth as well. When we look at the contribution coming in from the different segments, our mainstay is the corporate and institutional business, has been over the years, but you will see that the personal and business banking segment has the lion's share at 43%, and other income lines also doing very well, in particular the treasury side, and other subsidiary businesses also contributing through dividends, rental income, and that total picture then showing the diversified approach to generating income. And this is something that we're continuing to build on. So this then summarizes what we have seen for the year. Shareholder value, our returns on equity up to 16% from 13% the year before, with the earnings per share at 6.7 shillings per share, up from 4.92 shillings in the previous year. That has allowed us to report or give a very strong dividend to our shareholders. So that's up 50% year on year at 2 shillings and 25 cents, which is what has been proposed and will be confirmed later, up from 1 shilling and 50 cents. So at 50% up year on year, that should, so far out of reported numbers, perhaps be the largest jump that we have seen. If we look at the financials, just to recap again, total assets are up 5%, loans and advances up 13%, PBT, profit before tax, coming in at 15 billion shillings for the group, and that translates to about 11.5 billion shillings as profit after tax. and we look at, we measure this through what we call the Net Promoter Score, and that came in total for the group at 62%. Now, this is really a strong number for the banking sector. Typically, if you get over 35%, you're doing well, but it reflects the mix of businesses that we have across the group. In different countries, you will see that some are higher, some are lower. We have been looking at the performance of our strategy through the lens of how much new business is coming in, and this is a mix of both new lines of business being given to existing customers, but also new customers coming on board, and that ticked up from the previous year to 9% from 7%. And also looking at the contribution that comes in from our regional subsidiaries, that PBT contribution has gone up 2% to stand at 13%. Now, all of this wouldn't be possible if we weren't maintaining strong performance on our funding and liquidity. And when we discussed deposits, we saw that that was up 5%. But a key requirement, of course, for a bank is how strong your capital ratios are. And that has been maintained at 21%, which is a very strong number given that the requirement from our regulators stands at about the 14% mark. Liquidity ratio, strong again at 46%, while it is down on the previous year. Liquidity ratio really is also an indication of how well you are deploying the available deposits into lending. So with the 13% growth that we are seeing in our net loans and advances, you will see that that has meant that we are using our available deposits to actually fund growth in the customer segments. So consistent performance for us. Now, what is then our outlook for 2023? Here we won't talk numbers, but you will have seen from some of the things that we have been putting out some exciting campaigns. You've probably seen the impact that our Nisari Kabisa campaign has been having, where we have removed the charges on bank to mobile wallet transfers, and this is being very well received by our customers. We will continue to leverage on our corporate strengths. We have a leadership position we expect to maintain in the trade finance, institutional banking side, and transactional banking. And initiatives like Nisari Kabisa will certainly support that. We are looking at sector expansion, so looking at supporting a key element of our economies, which is agriculture in all the different markets in which we operate. And of course, looking at how we can support key import sectors like the oil and gas space. Our retail business has been on a growth path. We've introduced new capabilities for our businesses there. We have started personal lending, which is an area we hadn't been really tackling in the past, but you will have seen over the last 2 years that we have introduced personal lending, personal unsecured lending, and this is something that is growing. We are also introducing MSME unsecured lending. We have also been looking at the value chains. We talked about ecosystem banking previously, and we've been looking at our corporate clients and how we can support them in their value chains. So the supply chain financing, stock financing is something that has been well received. All this, of course, leveraging the investments that we talked about. We've spent over 2.3 billion shillings over the past few years just investing in our platforms, making sure that we have robust digital platforms that can support our strategy. And certainly our customers have been seeing this impact. As a group, we continue to see the opportunities in operating more coherently as a group, and looking at how we can centralize any processing that helps us strategically manage cost. And these are things that, this is an element then that we look at in terms of what services we can put centrally, what kind of technology we can deploy. So if we look at one particular initiative, which is the BRISC platform, this has helped our customers to really make payments across all the different geographies in which we operate by just using one account. And that strips down the costs that we see our customers facing as they pay for their trade flows. So really a story then of maintaining our focus on innovation, making sure that we are leveraging the strengths that we have in digital, our partnerships with clients. We pride ourselves on being a relationship bank, and this is something that we want to leverage going forward, even as we set out in new market segments. So that brings to a close what we wanted to share today. And we would be happy to all answer the questions that you may have. Thank you very much. Good. So we will now get into the Q&A section. There are mics which are going round. If there are any questions on the numbers or on our strategy, we'd be happy to answer that.
Any questions? Please state your name and your ideas.
Thank you very much for this financial year 2022 release. My name is Paul Arigi from Business Quest. You have said you're trying to come up with a fund for SMEs as an addition. I wanted to know how much you projected in that. And also last year, almost last year, there's something you call it German desk. It was something which you launched in collaboration. I want to know what the status so far since you launched it in the market. Thank you very much.
Okay. Right. So let's start with the question on the German desk. So we have the only German desk that operates in East Africa. This is in partnership with the German government through its development finance institution called DG. And this was established about 5 years ago. We actually celebrated 5 years of existence of the desk. It has led to over, I think it was over 800 million shillings that we have had in terms of investments done by various clients. But it operates right across the different markets that we have. The idea is really to promote bilateral trade between Germany and Kenya. So any companies from Kenya looking to set up trade with counterparts in Germany or vice versa, German companies looking to come into the Kenyan market, we facilitate account opening, access to different partners, advisory, so that it makes it easier for them to do business in the respective markets. So that is something that we are continuing. I would also take the opportunity to say that we also do have a China desk, which facilitates the trade between Kenya and China. We have a large community of Chinese businesses here in Kenya, and a lot of Kenyan traders also do a lot of imports from the Chinese market. So we facilitate, again, that trade corridor, business in that trade corridor. On the SME question, we have different lines that we are looking at. And we have, I think we had announced earlier that we'd set aside about 6 billion shillings to support our energy, our green energy business. A lot of that is being seen in the SME space. We have about 35% of our balance sheet at the moment dedicated to supporting our personal and business banking side. So really in terms of a number, not such number dedicated, but certainly in terms of the focus that we have for the segments, clear balance sheet support in that area. We have been tying up with partners. We talked earlier about the partnerships that we leverage to support our clients. And that in particular was about $15 million that we had signed up to support growing businesses in that space. Other questions? Yes, please.
Good morning. My name is Kefam with the Business Day. 2 questions. I was expecting to see an update on Uganda. Now I am Bank Uganda has been added. I'd like to see its contribution to profit perhaps and also the assets added. On the same update, you would give us another. You're going to be raising that price, final price paid that has been under review for the past year. You will have an update on that final clarification of that. I think that would also be important in terms of what happened with that exchange.
Okay, to follow. But the Uganda business saw a turnaround in its first year. You'll recall that in 2021, when we had just acquired the business, we reported a loss for the year. The activity that we've been then supporting in the business last year has led to a profit for the year. You'll get the number shortly. In the press release, it's actually detailed. But the underlying performance, growth in customer numbers, we have seen that coming very strongly, particularly from the corporate side. So clients that we have that are common to us here in Kenya and in Uganda supporting that. We have also seen strong recoveries coming in from the clients that we had in the business, and we worked on supporting that. So strong performance, and we expect that we are going to see continued business. Gul,
what comes into my mind first thing is institutional banking and corporate banking. I noticed that number had a slight decline in the year. What could be the reasons behind that, and what are your strategies towards growing that business? Because that's your name.
Thank you. Thank you, first of all, for the compliments on our performance. Yes, I did indicate that we had seen a slight dip in the contribution coming from the corporate and institutional banking business. That, however, is not due to the absolute performance, which actually over the last 2 years has doubled in performance, right? What it really indicates is that the personal and business banking segment has been growing a lot faster, right? And its contribution is therefore greater. So, for example, if we look at our retail business, just in the last year, with the unsecured lending product that I talked about, we have seen over 2 billion shillings in new loans written, supporting over 3,000 clients, new clients. As we introduce workplace banking, which I talked about, we expect that to scale even higher. We have also had a more focused offering on the business banking side. So when we look at the stock finance and the supply chain finance that we discussed as new expansions on our customer value proposition there, that's expected to also scale in terms of balance sheet and ultimately income contribution. So really, it's a good story of 2 different segments growing quite fast. We've been doing quite a lot of work on the corporate side to make sure that we can support particularly transaction banking. So you will have heard about our revamped M-Pesa offering, so M-Pesa Pay Bill offering, which allows our customers to receive absolutely free the inward payments into their accounts, right? Now, their customers may be charged, but they themselves don't get charged for receiving those payments. And that helps with our current accounts and savings accounts growth, which you will see from the final accounts when you analyze this, that actually we've seen the contribution of current accounts and savings accounts grow to almost about 43% from 36% last year. So all of this is a good story and reflects the high dividend yield that you're now seeing in the results that we've published. So I think at 13.3% or so, the dividend yield we have reported is perhaps the highest from the numbers reported so far. Question over there?
Good morning. My name is Frank Origo, financial analyst from Abuja. And I have a couple of questions. And I will give you the first question. I can see as you have reported quite impressive results of 11.6 billion profit after tax. And but still, or even however, you have reported a loss of 688 million in I&M Tanzania. What is, or even what could be the reason? Is it the macro factors in Tanzania, and also considering that the Tanzanian economy is growing quite fast, and also East African economy as well is also growing quite fast? What could be the challenges you face as I&M in Tanzania? And my second question goes to the loan provision of 25%, which is an increase in this case. Have you increased the loan provision to 25% as well to cover even as an NPL coverage, or it is purely loan provision because of the current business environment, anticipating maybe some people might default to be honest, some customers might need it. And also, what percentage of NPL does this loan loss provision cover? A certain percentage, as well. What is the credit risk associated with that loan provision as well? I think those are my 2 or 3 questions on that.
Okay, so let's start with the credit questions. So the driver, of course, on the provisioning is both loan book growth. So you grow your loan book by 13%, you're going to see your general provisions also going up. We have also had to really take a prudent stance with some sectors that we are seeing some pressure in, and that has led to prudent provisioning. We also have to take into account that over time your non-performing loan book also has to adjust for the discounting of securities that is required by the central bank rules. So that has been essentially behind the 25 billion shillings that we've seen. So increase in total provisions is about 4 odd billion shillings. Now, what does that mean in terms of coverage, in terms of the provisions that we've taken? Our coverage is still at about the 55% level, which is pretty strong. We take the approach that we do not want any residual exposure. So we look at the value of the securities that we have, we look at the non-performing loans, and we provide for the difference so that we have a net zero position. Now, turning to the Tanzania question. So first of all, let me say that the Tanzania business has had a very long track record of profitability and actually dividend repatriation. Indeed, perhaps when we look at all Kenyan outbound banks, we have perhaps had the most consistent performance in that space. Now, the last 3 years with COVID had been tough for all banks in that market, and essentially it was a question of timing and navigating also the accounting rules that are set by the regulator in that market. So really that has informed how much we take in provisioning this year, and that meant that in that process of cleaning up, the resultant position was a loss for the business. The underlying performance of the business is strong. We've seen the net interest income, non-funded income grow strongly. really the big challenge in that market was just what we needed to provide for. And we expect, and we are seeing in this year already, that is an improved performance. So really cyclical, but that was the outcome for Tanzania. Have we covered all the questions? Yep. Okay, good. Yes, please.
Good morning to all of you. My name is Ola Halai. I'm a cyber calendar journalist from UNCTV. I have 2 questions. The first question is regarding the recent FX code that was being launched by the Central Bank of Kenya, effective on 23rd. Like, have I&M as a bank complied to that? And how is you guys complying to that of positive importance to you and your financial output, but also to the negative side? Another question is about what is the future of the USD KSH exchange rate maybe in the next financial year?
Okay. So maybe the latter question is a trick question, right? Because of course, if we had that number, we would perhaps not be bankers, right? We'd be traders, personal traders. But what I would say on that latter question, I think if you look at the long-term performance of the USD Kenya shilling pair, it is driven by economic fundamentals, right? You've got a net import economy. You import more than you have available as exports. So structurally, you expect to see depreciation over time. And long term, that has been at about the 6 to 7% level. The conditions that we saw over the last few years have been quite unusual, even though we understand the context of the performance of the currency in that situation. So you had COVID, which led to dislocation of the markets. You saw commodity prices rise quite dramatically. That inflated our import bill as a country, and we also saw exports take a bit of a knock. So what that meant is that you had a real gap in your demand and supply, and that then led to, of course, an amplification of the weakening of the currency. At the same time, there was, when you have such market conditions, you get a bit of a dislocation between what's the official rate and what other rates that the markets are using are. And any market really wants to make sure that you have alignment between all the rates that are being offered by different market players. So the FX code is really a welcome intervention by the central bank, and of course they are working in concert with the banks. The idea really is to highlight several principles that must be present in the performance of a market, right? This include, of course, ethical trading, making sure that you have reciprocation, you are providing liquidity, and these are really critical for the market to function well. We know that the markets haven't been functioning as well as they have done in the past, and this is something that is critical for us to be able to support the growth of the economy. You really need to get market making happening in a banking system for the easy servicing of your import needs, or indeed conversion of your export proceeds into local currency. It is drawing on the global FX code, which has been adopted by over 85 markets around the world. And it's really not unexpected that we would tap into experience that has been seen in other markets. So it's early days yet. In terms of how we are complying, of course, they've laid out several steps that each bank must take. What we will obviously do is self-report in terms of our compliance to that. But it is not something you just do individually. As a market, you have to have all the participants operating. So we are at the forefront. Our treasurer, Harish, is very involved in making sure that we have the right kind of engagement with other players, and providing the right kind of input on what is going to make the market perform at its best. So we expect to see that going forward, greater liquidity will come into the market. A lot of the fear that perhaps had invaded the markets, the small sizes that we'd seen trading because you didn't have liquidity, all of that will eventually end the banking sector.
My name is Cyrus from Zalendo News. I have two questions. Number one, we had the government of SMEs, Mama Mboga, and Mtu wa Chini, so to speak. So as a group, how is the bank going an extra mile to push for more incentives and investments for small business owners? And number two, being the only bank in Kenya, if not being the only bank in Kenya without charges for mobile money transactions, how is the outlook so far? And will you reinstate charges in the near future?
Right. So one of the things that we pride ourselves on as a bank is that we listen to what our customers say. We regularly poll our customers to see what they are feeling about developments in the markets. And really, the removal of M-Pesa charges, as you heard from Go, was a response to that. So we're very specific about which charges we were removing. You'll recall that charges were introduced in late 2022 to start in January. And I think the feedback that came really informed us that we should consider how we can mitigate the impact this is having. Now, we are already getting feedback on that that is positive, in terms of how much banking charges at that level really translate into savings for our customers. So this is something really positive. Now, when you look at your Mama Mbogas, Mtu wa Chini, what are we saying? This is already a big investment in terms of making deploy those costs into their businesses as working capital. We are looking at the investments that we've been making on the which allow us to
growth, or you are also banking on, or even you are also attributing your future growth on reducing these expenses looking into 2023. That is my first question. My second question will go on return on equity. Definitely, the returns you are able to get on the equity you have. Like I see that it is, or even comparing to the past years, that is 2019 going back, the return on equity from 2019 going back to 2013 was quite high. 2013 it was 22.55, 2014 it was around 24, 2015 it was around 23.19. But comparing that to the current return to equity of 15.14, as much as it is an improvement from 12.39, are we looking at a possibility of going back to the return on equity I&M was having in the past years, looking into the future?
Thank you. So quite some interesting questions there. So let's start with the cost-to-income ratio. It are using to generate the revenue for the year. And I think it is important to look at what our business has been growing. So in terms of number of staff, that has increased dramatically as we have looked at new businesses that we are creating. Staff costs have had to increase. We've also been investing in what you'd call strategic costs, right? So when we talk about digitizing our business, we're looking at new platforms, we're looking at software development costs. All of that is strategically designed to make the cost to serve our customers come down. So the increase in costs that you've been seeing over the past few years is really about investment. And that is starting to, of course, translate into the higher revenue different lines that we are starting. We've talked about the push into retail. We have looked at how much of our transactions are actually coming through the digital channel. I think in Kenya, it's about 93% of all transactions are actually starting on the digital channels rather than on the branch side. So this is strategic investment in cost. So really it is both sides of that ratio being worked on. We know we will see initially that increase in cost as we invest, eventually that cost. On the income side, that then grows as the new businesses that we've been putting out mature. So on the retail side, we expect to see some significant services that we'll be deploying through the platforms that we've invested in. So when we look at our trade business, we expect to see more flows coming in as we operate more seamlessly in that space. On the transaction banking side, similarly, when we really, if you've been looking at the releases that we've been doing on our, that greater functionality is being provided to our clients. So more of our customers really using those platforms, and that helps bring down the cost ratios, if not the lowest. I think we've been as low as 33% in the past. But over the past few years, we've seen that tick up a bit. I think for 2022, it came in at about 40%, just under 40%. So, but it's something that we expect to see over time really come down. I think very few banks can talk about a cost-to-income ratio lower than 40%. On the return on equity side, this is, of course, going to be driven by the growth in revenue that we are seeing, the efficiency that we've just talked about, and of course the prudent application of our credit approach to making sure that we are writing the right kind of credits, but also being prudent when we take our provisioning, so that net interest income grows as expected. Now, of course, you expect that over time in a market, efficiencies are going to kick in, right? If you look at other markets around the African space, you will even see returns on equity that are higher than 40%. And this is a space that even Kenya was at some years back. However, this should narrow. You shouldn't expect to see that outsized kind of returns on equity, which typically would come in when you have very high or very low penetration and therefore very high, perhaps, margins that are being charged to do business. So as you get more competitive, and the Kenyan market is actually quite competitive, you expect to see a narrowing in that. But it is also about how you optimize your capital, and we have been focusing on optimizing our capital base to make sure that we have the appropriate level of equity to do business. It's a balancing act there. We have to make sure that we are anticipating shocks which are sure to come. We've been seeing every year new shocks coming in, so we have to really hold capital that will help us withstand those shocks. Long story short, we expect to see our target returns on equity in the range between 10 to 20% or so being maintained over time. And as markets grow, we are expecting to see our investment